Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. European defence stocks called sharply higher as the region's leaders pledged to boost defence spending and step up their support for Ukraine. Markets brace for more Trump tariffs ahead of Tuesday's deadline for levies on Canada, Mexico and China. Plus, investors on notice for more China stimulus measures ahead of the country's National People's Congress. We'll discuss what to look out for this week.
Well, happy Monday, everyone. Here's where the weekend's events have left these markets. That car crash in the Oval Office knocking euro-dollar, but it's back up this morning on the plans for more European defence spending. European futures also higher. We could see double-digit gains for some of these defence names in Europe. Meanwhile, in Asia, stocks higher on the expectation of more China stimulus, tech optimism as well. And we have Bitcoin back above $90,000 on Trump's Truth Social post, though that rally now consolidating. The countdown to the opening trade starts right now.
Monday morning, good morning. Europe is about to rearm. The impact on European markets is about to be felt. As we've already indicated, I think you're going to see defence stocks sharply higher this morning. Keep an eye on the bond market. And the euro's on the move as well. Yeah, absolutely, Guy. All of those worth checking in on this morning, because we are expecting substantial moves in some of these defence names, seeing suggestions they could some up more than 10%, some up more than 15%, even up more than 20% in some cases. So we certainly look for defence stocks to go higher. That defence spending, how's it going to be paid for? Bond markets will respond. We've seen German Bund futures are down, French OAT futures down, so yields will be higher this morning at 7:30 on the cash trade. And the euro bouncing a little from its losses on Friday, and Eastern European FX also fairly resilient this morning. In terms of what happens from now, well, we wait for every twist and turn of this geopolitical narrative as it unfolds. What will Zelenskiy say and do next? What will the US administration's stance be? We head towards an EU summit that's been brought forward. That's going to take place on Thursday.
And a big question is, what will the figure be for this military aid package to Ukraine? Previously, the figure was 20 billion euros. Macron, in an interview with Le Figaro newspaper, floating an idea of 200 billion euros. So that will feed into the market narrative of how much defence spending there will be. But of course, it comes back to this question of whether there'll be a US backstop. And you had the NATO Secretary-General Mark Rutte saying that it's a debate that is ongoing, and Keir Starmer saying that he's clear Donald Trump does want a lasting peace. That peacekeeping backstop, the definition in Ukraine's mind of a lasting peace.
Park the politics for one moment. Let's just think about this from a market perspective. Defence stocks are going to be sharply high. They've already had a massive rally since the beginning of the year. Yields are likely to be really interesting, because I think you've also got an ECB meeting coming up this week. Ultimately, if Europe is going to pay for all this, how's it going to do it? Do we need to see lower interest rates? If you put Europe on a war footing, historically that has been something you've thought about. Is that the longer-term story here? So while yields may rise, ultimately they may have to fall. And what happens to the welfare bill across Europe? Weekends filled now with stories of welfare bills being cut. How does that play out politically?
Yeah, absolutely. I mean, what we don't know right now is the exact scale of the spending that's going to be required here. What we do know is that it hasn't been priced in, and that's certainly clear from the expectations of the market open this morning.
Of course, the other theme in markets this morning is tariffs. Tomorrow, just after 5 a.m. UK time, we're going to have the proposed tariffs on Canada and Mexico taking effect. Over the weekend, the US hinting that they could be lower than 25%, and they could yet be delayed. We don't know yet, but it doesn't appear there's a lot of wriggle room for China when it comes to those additional tariffs. You just have to ask whether tariffs are going to lose their power if they're not implemented, and whether Trump will have to go for it at some point because he needs the revenue for his tax cuts.
What kind of a world are we going to be living in? Is it going to be a higher inflationary world for the United States? That certainly seems to be the takeaway from the tariff story. What does that mean for the Fed in terms of what it does? You put this together with you've got tariffs, and you've got Doge, and you've got the growth story, and you've got a potential shutdown coming. Are we going to see lower growth in the United States?
Yes.
And is it a lower growth, tepid growth story with higher inflation.
We have focused very much, haven't we, on the inflationary impact of tariffs in the States, maybe less so on the negative inflationary impulse coming from those DOGE measures. And the longer that goes on, and we, of course, take into account legal challenges, but that is going to be something we need to price in more and more. Interesting to watch the retaliation that we might get from China to the tariffs. I know we're going to come on to China in just a second. Global Times talking about food and agriculture being the focus. Tariff and non-tariff barriers will be something that China is going to be thinking about here, and they have a history of imposing antitrust probes, export controls, so all of that could be in the mix.
The Canadians are talking about raising an export tax on their oil. So their oil's going to be taxed at 10%, tariffed at 10%. The Canadians are going, OK, fine, yep, we'll raise it even higher so that the US consumer suffers, so that you see the inflationary impact, so it feeds through politically.
This is the unpredictable retaliation.
Yep. That we're all watching so carefully. You bring up China, so let's talk about this from another angle, and that's, of course, obviously the big meeting that's going to be taking place Wednesday. It's going to come just after the arrival, potentially, of these tariffs. How do Chinese politicians, A, keep the rally on track, deal with the tariff narrative? What does that look like? Where are they going to focus any spending push that's going to be coming through? Is it in the tech space? Is that the new growth driver? How that response comes, I think, is going to be really interesting. And does it get shaped quite late as we await the arrival of the tariff story? I don't know. How much of this is already set in stone and how much of this is flexible depending on what Washington does?
Yeah, is this just the beginning where it has top-ups throughout the year? Usually these announcements are pretty underwhelming for markets, and that's the way markets are priced for it going into the NPC meeting. So you've got investors buying bonds, selling stocks, because usually these announcements don't excite animal spirits, as you would expect.
Yeah, although we seem to hang on for the occasion when just maybe, possibly, it might. We certainly went up that hill and a little bit down that hill back in the autumn, in the fall of last year, didn't we? But the budget deficit could be in focus in China. So to what extent are they prepared to increase the budget deficit to boost domestic spending? Seems to be one of the things that Bloomberg Economics is talking about going into this. It could be the highest in 3 decades, that budget deficit in China, so that's something to watch.
Where does it get spent, I guess, is the critical question. In the past, it's been spent on infrastructure, housing, those kinds of areas. Is that where it's going to get spent? Be spent this time? Let's talk about the great guests we've got lined up to talk about all of this throughout the show. 7:30 a.m. Tim Ash is going to be joining us from RBC Blue Bay, EM sovereign strategist. Significant views on what is happening in Russia, what's happening in Ukraine, how Europe is going to be rearming. How does the market perceive all of this? Karen Chudid, BlackRock EMEA investment strategy head, is going to be joining us to discuss that. Rob Murray, Defence, Security and Resilience Bank founder, is going to be joining us. The idea there is that you basically have a defence bank that funds the defence spending that Europe needs. It is government backstopped. Is that any different, really, to joint debt? I don't know. I think that's a question we need to ask.
Well-timed. What kind of role for the United States, if any, in that kind of initiative?
And so necessary when you have such fiscally constrained governments. But coming up in terms of the data today and throughout the week, we have euro area inflation today. Tomorrow, Trump addressing Congress and the tariff deadline that we just mentioned. On Wednesday, the China NPC meeting, as well as US ISM services data. On Thursday, 2 crucial events, the EU-Ukraine summit and the ECB rate decision, which is more market moving, you might ask. And then on Friday, the jobs report and the chair of the Federal Reserve, Jay Powell, speaking. On that jobs report, are economists expecting a weak print? The headlines obviously focusing, as you say, on the DOGE efforts to cut government spending. But is it that the government funding freeze has more of an impact on hiring than those efforts?
I mean, Friday just feels like a very long way off right now, doesn't it? I mean, every asset feels like it's in play this week. When you look at that list of things that are taking place, we're coming at this from every angle. Everything is on the table.
We'll talk about crypto a little bit more in just a moment. The labour market is going to be fascinating. If you think about what the Fed has now got to do, it has a mandate to look at that. It has a job to look at what is happening in the labour market. But does the tariff narrative take over and ultimately deliver a higher inflationary story going forward that ultimately means the Fed has got to just sit and watch tepid growth on one hand, a moderating labour market and inflation that is proving much more sticky? And does that basically just leave it on the sidelines?
Yeah, and if you just look at the pricing at the moment, markets have added an extra rate cut to their outlook over the last 3 days of last week. So that's where we're standing heading into this busy week when it comes to the Fed.
Yeah, we've got a great track record over the last couple of years predicting what the Fed's going to be doing, don't we? Anyway, what else do you need to know this morning? Let's talk about something a bit more fun. Anora has triumphed at this year's Oscar, winning 5 awards, including Best Picture. Its star, Mickey Madison, was named Best Actress after what was her first Oscar nomination. Adam Brody won Best Actor for his role in The Brutalists. Zoe Saldana was named Best Supporting Actress for Emilia Perez. And Kieran Culkin won Best Supporting Actor for his role in A Real Pain. Hong Kong-listed Prada is said to be moving closer to a deal to buy Versace after agreeing a price of €1.5 billion. Sources say the deal with its current owner, Cadbury, could be finalised this month. An acquisition would allow Prada to create a larger Italian player to better compete with luxury rivals LVMH and Kering. And the crypto market is starting the month with a huge rally. It's recouping some of the losses from February, which was the asset class's worst month since 2022. The move, of course, comes after President Donald Trump once again talked up his plan for a strategic crypto reserve, which will include the likes of Bitcoin, Ether, Solana, XRP and ADA tokens, with many of the details of the plan still unknown, including how much the government will actually buy. Remember, it's already got some, and how the purchases will be funded. I think the interesting thing here is, well, from a market point of view, there's two interesting things here. One of which is there a Trump put? I.e. crypto falls out of bed, Trump steps in to stabilise the story. The second one is crypto was becoming a little bit of a concern from a contagion point of view. And you do wonder whether stabilising crypto will have a ripple effect into other markets like equity.
Absolutely. The link into other risk assets is really fascinating, isn't it? I mean, it's also worth noting that of the 5 tokens that he mentioned, I think 4 of them are actually still just down versus where they were on Inauguration Day. So, yes, so that's important to keep in mind. And I suppose he's answered your first question in at least once there was a Trump put. It was over the weekend and it was exercised because we did see a lot of negativity around crypto last week. And then what did we get over the weekend? We got the name check of some assets, sort of iterative process of giving us a little bit more on crypto just to reignite the fire.
Yeah, but we still are awaiting lots of details. The inclusion of XRP and ADA, surprising to some analysts. We knew that you were going to see Bitcoin and Ether in there. But, you know, when you talk about the kind of reversal of the Trump trade, you can't just do it with Donald Trump because there are other factors in the recent drop, right? You had that hack of the Bybit exchange.
Sure.
You had, you know, just the standard cash and carry that was happening between the spot and the futures markets. It's not all...
No, there's a medium-term story which has other factors to fold in. But if you think about risk assets, so if you take this out into the wider world and look at what happens with equities, say equities roll out of bed and hit their head with a big bump. Does Trump, how important is the S&P as a metric for how well he is doing in his head?
Yeah. Or is it all about 10-year treasuries? Because that's what Scott Bessent has been pitching recently.
It feels different to Trump 1.0 this time round. And if that's not the case, what happens to equities going forward? Because I just wonder whether there's that belief in the market that Trump will protect the equity market. And if that doesn't prove to be the case, then that's a much more dangerous story. But the weekend story would seem to suggest there is one, maybe.
We've got some guests coming up, haven't we, who might be interested. Even if they don't follow crypto, the link between crypto and other risk assets, I think, is something you have to think about with Trump in the White House. President Trump there once again, of course. Coming up on the programme then, Finland's President Alexander Stubb says that Russia must be countered with strength. Otherwise, it won't stop with Ukraine. More from that exclusive interview that we had with him over the weekend later in the programme. Plus, we'll watch European defence stocks, of course, at the open. As the region's leaders pledge more spending to counter threats from Moscow, we are expecting to see those defence stocks really jump at the start of trade. Up next, we'll be joined by Jose Minaya, Global Head of BNY Investments and Wealth Management. A great conversation to kick off the week. If you want to get involved in any of these conversations we're having around the desk, then please do. IB plus BDTV Go this Monday, the 3rd of March. Please get in touch. This is Bloomberg.
I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have Fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
That was, of course, the US Treasury Secretary Scott Bessent speaking exclusively to Bloomberg at the back end of last week. Talking about the tariff story, talking about the North American story, it's interesting to see how Mexico and Canada are responding right now. Let's talk about one of the aspects of this week ahead and figure out exactly what the FX market is looking like. Valerie's here with the details.
Guy, it seems like the FX market is quite muted when it comes to this deadline today. I've got a chart behind me of FX vols, the 1 week at the money implied option volatility. If you compare this to the option volatility that was priced in for the election, it's way lower. If you compare the CAD volatility to what was priced in just a month ago at the previous deadline, it's also way lower. This is telling me that the FX market thinks that a tariff delay is on the cards today instead of an implementation. But another thing we have our eye on, Guy, is what's going on here in Europe with all of the European countries promising more defense spending. You got to start begging the question, are they promising something that they can't afford? And are we tempting a return of the bond vigilantes when they see the size of these spending packages of these European governments that they want to spend? For now, it is seen as a positive reaction. We have both the equity market and the euro rallying off of this, but I would keep my eye very closely on the bond market. And do they think that they'll be able to absorb this upcoming bond supply? Another aspect of this is those defense stocks. They have been indicated higher on TradeGate, some of them to double digits. This European stock rally for those defense names is not over yet. Rheinmetall already up some 67% year to date. If those pre-market gains hold, we're looking at a near 80% rally for the Rheinmetall share.
It's a volatile morning. I think we can probably take that, except maybe for the FX space, which maybe is getting a little bit more immune to what is happening on the Trump tariff narrative. Valerie, thank you very much indeed. Joining us now is Jose Minaya, Global Head, BNY Investments and Wealth. He helps oversee $2.2 trillion in client assets. Good morning. Nice
Good morning.
to see you.
Yeah, good to be here.
There's a lot of volatility.
It's another Monday.
It's another Monday. We've got a lot to think about. As you come out of a weekend into a week like this, is this a week when you take less risk? Is that the sort of the overriding instinct? There's so many unknowns. There's so many tail risks. There's so many factors that we are struggling to understand and price. Is the best reaction just to sit back, see how it plays out? Do you need to take less risk?
Yeah, I think that's the right muscle reflex. But the reality is, I think this is a new normal, right? And I keep using the term is kind of back to the future, right? Is going into 2025, is it really that different from 2024, where we were looking at constructive markets, yet concerns around inflationary pressure, and then, of course, more uncertainty? Going into this year, what's interesting is, I think it's more of the same, except that, from a growth perspective, there's more optimism, especially in the U.S. From a risk perspective, the uncertainty has kind of increased, right? That risk is around what can happen from a policy perspective, what can happen from a geopolitical perspective. But what we tell our clients is, look, don't invest on kind of your politics, right? Think about the long term and what we're doing here. You're going to continue to see more uncertainty in this market. It's about the outcomes in our portfolios. It's about the solutions that we want to do. And it's more around the medium to the long term, not the short term.
Do you still see risk assets going higher?
By the way, they have been going higher. And I think you'll continue to see that throughout the year, because I think you'll see a market where the S&P is up low double-digit numbers for the year.
The Nasdaq's flat on the year. Like with the risk assets, the S&P's flat on the year. The Nasdaq's negative on the year.
It started up in the year, kind of. There was a reversion kind of trade there as well. But I continue to think you're going to see more constructive kind of growth perspectives going into the year. Though they will support the market, and you're going to have weeks with a lot of noise, like this particular week. But you know what? I tell you, this is the new normal, right? Yeah. It's like, get ready for more unpredictability. What the market definitely expected from a Trump administration was one of pro-business on one end, and on the other end, hey, more uncertainty, the carrot or the stick. Yeah. And this idea that net positive to the carrot. This week feels net positive to the stick. You may feel differently next week or next month.
Yeah. Let me think about how this plays out in Europe then, because we've already seen European stocks do well versus US stocks year to date. Mm-hmm. And defence stocks set to rally considerably this morning, given all the politics that's been playing out and the rethinking or the tectonic plates in movement when it comes to who spends what on defence. Is that, from an international perspective, international investor perspective, is that the trend you lean into in Europe? Anything that benefits from higher defence spending in Europe? Is that one of the main plays right now?
Well, obviously it is this week, or it is this month. I mean, I still think the narrative kind of globally coming into into the year is one where, U.S. exceptionalism, right? I think there is more optimism around growth prospects in the U.S., a little bit more muted in Europe, which is why I'll likely think that the Fed in the U.S. is unlikely to cut rates this year, in my opinion. I think the market today is kind of pricing in maybe 1 to 2 cuts. I think you're going to see in the next 3 meetings in Europe, Fed cuts of 25 bips. Again, because there's a little bit more of a muted, the inflation is a little bit more under control in Europe. Then again, more concerns around growth. So I think that's kind of the narrative throughout the year. And again, you're going to see different themes play out any particular month.
And are your clients nervous? When you talk to clients, Jose, are they nervous about that growth story in the US? Because there was a lot of enthusiasm for the reasons you describe about another Trump administration on the growth front. But then just over the last couple of weeks, people starting to ask questions about whether the whole climate of uncertainty that a Trump administration seems to have created on so many fronts in the short term might be growth negative.
Yeah, it goes back to Guy's point around kind of taking risk on that. I think, like I said, last year there was a lot of nervousness. Going into the new year, I think there was more optimism around kind of risk on, more positive on the growth side. Obviously, this week you're going to see more nervousness around this. But I think on the whole, there is a viewpoint of, again, the carrot or the stick, that it's going to be net positive to the carrot side, and there's going to be more constructive markets going in through 2025.
Well, on the stick, Val was talking about how the FX market kind of suggests a delay for tariffs rather than implementation. Do you believe that's what's going to happen? And if actually you do see a cut in the level of tariffs, how do you change your positioning around that?
Yeah, I tried not to make these bets in the short term of what's going to happen or not. I will say with the tariffs, I'm happier where the discussions are today, right? If you think about it, these discussions initially started on the campaign trail talking about 200% tariffs, 100%, broad range tariffs. Now they're a little bit more focused, right? Again, the negotiating tactics of the current administration in the U.S. might be a little bit different than what people are used to, yet I don't know where it'll settle down, other than there is more uncertainty. There is more opportunity for these policy mistakes to happen, which is what makes everyone uneasy. But again, the narrative maybe has somewhat cooled down, where hopefully these tariff discussions are ones where they're more targeted and less disruptive to the broader markets.
So more opportunity for policy mistakes. What about opportunities around the tariffs if they go ahead? In emerging markets, for example, Val was talking about some of the currencies. Do you look to Chinese AI? Do you look to Dubai equities when you've got the dirham pegged to the dollar? Where are you seeing the biggest opportunity to proof yourself against Trump's tariffs?
Well, I think the biggest opportunity from I have the advantage of looking at this from a broader view, is active management is going to matter again, right? Because in this world of uncertainty, this idea of just kind of investing in index funds or just kind of being in a 70-30 portfolio, I think moving more to this view that there are going to be these different opportunities, and going back and being aligned with people that are able to kind of make those bets, I think is going to be kind of a trend in the markets going forward.
So what are we hearing here? Is it business as normal, i.e. 25 looks like 24, or is it there are more policy mistakes, there's more potential here, there's more room for error, I need to be active? I'm slightly confused as to what the message is.
I think the message is there's absolutely more room for error. And again, this goes back to the, how your position in your portfolios matter today. This idea
if I'm going active, though, I'm taking more risk, not less risk, aren't I?
Not necessarily, right? It depends on what your outcomes are and what you're looking for. You may be in a situation where you want to protect your principal. Well, there's different bets you can make to that way. But the idea of being invested in ways where you're looking to take advantage of these opportunities is the key here. Whether that is a more risk-on approach, less risk, it depends on the individual. It depends on the institution.
Okay. Back to the future. Jose Minaya, Global Head of BNY Investments and Wealth. Really good to have you around the table with us this morning. And coming up, the UK tells Europe to step up to meet the challenge of securing Ukraine as questions on the continent rise about the commitment of the US. A lot to look ahead to in terms of the impact on defence stocks. We'll get into the details next. This is Bloomberg.
Welcome back. This is the opening trade, Monday the 3rd of March. After a really busy geopolitical weekend, plenty to focus on in Washington and here in London. What does that add up to? Well, actually, not really very risk-off. Certainly you count in the defence stocks and the extent to which they'll be positive at the start of trade. I wonder, ex-defence, what the markets will be doing, but we'll dive into that conversation a little bit later. We are expecting then European stocks to go higher. Let's have a look at the bond markets then, because they're reflecting the same story. We see yields in Europe a little bit higher this morning, not a huge amount, but a little bit higher on that ongoing expectation, fear, anticipation that we see further borrowing, higher borrowing here in Europe to fund some of that defence spending, Lizzie.
So that's what's happening in the markets. Let's get back to what's actually powering them in terms of the geopolitics. Ukraine's president saying that he is willing to meet Donald Trump again if the US president invites him to, quote, solve real problems. Volodymyr Zelenskiy met European leaders in London yesterday after clashing with the US president and the vice president in Washington last week. The UK Prime Minister Keir Starmer has called, meanwhile, for a coalition to take part in peacekeeping forces and to assure that peace in Ukraine.
We are at a crossroads in history today. This is not a moment for more talk. It's time to act, time to step up and lead, and to unite around a new plan for a just and enduring peace.
Well, for analysis, Bloomberg's Oliver Crook is in town with us. And Ollie, notably, in that meeting, you had all the like-minded leaders, but not the likes of Hungary and Slovakia, who wouldn't want to be in a coalition of the willing, right? So who's actually likely to be in this coalition when it ends up?
Yeah, so listen, I mean, I think this is part of the many questions that we're asking here in the post sort of Friday meeting, if we can say that, where it seems that for the kind of, maybe not the first time, but really people are taking very, very seriously the thing that we've heard repeatedly from the Trump administration in terms of their designs, reckoning not just with the U.S. backing out in theory, but basically reckoning with what the reality of that looks like. And again, the problem at the EU level is you have participants like Hungary who have blocked aid to Ukraine. You've had them throughout the sort of dialogue. The question is now, what is the new architecture? Who are the new participants? I mean, I spoke to the Prime Minister of Norway on Friday. He is saying, for one, that this is one that needs to include, of course, Norway. They're a very willing participant there. Turkey as well, with a very large standing army and one of the more kind of serious militaries out of all the European countries. But again, this is for them to discuss in terms of what this actually means. Because when we talk about a coalition of the willing, we're talking potentially about sending European troops to Ukraine to do what? To observe that the conditions of peace are being observed, or to return fire on Russian troops if they violate that? These are some of the questions, and all the lawmakers I've spoken to in Germany, even the most sort of hawkish ones, are very resistant to sign up to these sort of things. And of course, that hinges on one major development, and we heard from the Finnish president a couple hours ago, just yesterday. Have a listen to what Alexander Stubb had to say.
When it comes to bilateral alliances and actually regional alliances, so the relationship with Finland to the US, we do icebreakers, defense and technology, or when it comes to NATO, that's where we need to be steadfast with the Americans and say that, listen, the alternative cost of pulling out of NATO means that the US is going to lose its status as a superpower. So I'm still hopeful that we can work with the Americans. I don't think we should give up hope.
And so when you're hearing sort of one of the longest borders with Russia, basically the president saying that we can still work with the United States, but he's talking about the potential of them pulling out of NATO, that is the big question. It's going to be very difficult for any European nation to sign up to sending troops if they're not backed by the United States.
There needs to be air cover. There needs to be all kinds of factors that the US is going to bring to the table, which is really important. In order for that to happen, do we need to have a better Oval Office meeting between the president, the vice president and Zelensky? Is that what needs to happen here next?
I mean, I think that would certainly obviously help things. It's hard to imagine one that went any worse than it did on Friday. I mean, I think the capacity for that is, I don't know, frankly, to what degree that is going to be able to reorchestrate that. There's going to be a lot of wounded egos. There's going to be a lot of damage that has been done. How do you get Zelensky back in the room? Zelensky, for his part, has said he's still willing to sign up to the minerals deal that's still on the table. He has not given a sort of apology, a public apology. That is something that we know has been demanded by a number in the Trump administration. But the sort of very strange situation we find ourselves in here, and we think about this from the sort of Russian perspective, right, where there's been a lot of criticism by many of the European leaders about sort of Trump's approach to Russia. But we're in a position where you hear now increasingly from the U.S. administration talking about replacing Zelenskyy in Ukraine, right? Again, we're still working through the fallout of this. We don't know to what degree that is going to be really advocated, but this is something that was unimaginable a couple of months ago, and this is coming from the U.S. administration. This is something that not even Russia could have orchestrated.
Yeah, I mean, how much can the relationship between two men be put back together? Ollie, thank you very much, Bloomberg's Oliver Crook. Let's continue the conversation with Tim Ash, Senior EM Sovereign Strategist at RBC Blue Bay Asset Management and Associate Fellow at Chatham House's Russia and Eurasia programme. Tim, very nice to have you with us. Can Europe arm itself quickly enough? What's the limitation here? What's the limiting factor?
No, simply military industrial production. We lack it. The Americans have it. It's not about finance. We're a $27 trillion economy. There are immobilized Russian assets, $330 billion. We can use that to fund our own defense. We should have been doing that years ago. It's simply we don't have the ability to manufacture high-tech kit, HIMARS, Patriots, those things quickly enough. We will eventually, but it will take us...
How long?
Well, it's probably a 5-year span. That doesn't solve this problem. We are reliant on the Americans. I think the key for me in all this is still whether the US ultimately, whatever Trump's relationship with Putin, whether if Europe went to the Americans with a huge ticket defence procurement plan, 500 billion euros, €1 trillion, and said to the Americans, we want to buy your kit, whether Trump would say no to that. I don't think he would. If it's the deal of the century, the biggest arms procurement deal ever, it's jobs, jobs, jobs. That's what he cares about. So Europe needs to be clever, right? I mean, we need to bridge this gap.
So is there still a chance that... So, I mean, that might not be it might not be the guiding factor that's driving him right now, but if he was in a situation where he was able to spend less on defence, European countries spend more on defence, but US defence companies don't lose out. Well, is that the kind of solution he's looking for?
US defence companies win whatever. Right? I mean, I can't imagine US defence spending is actually going to decline given the China threat. But now there's this huge new market, bigger market opening up in Europe, right? I mean, just think, each 1 percentage point of GDP, from 2% of GDP NATO defence spends to 3, is 250 billion euros, right? Going to 4, 500 billion euros extra defence spend. A lot of that will have to be spent in the US. Again, I don't think he would say no. Ukraine itself is going to be a huge arms purchaser. Ukraine is learning lots on the battlefield in terms of innovation. The West and the Americans still need that. They're at the cutting edge of defence technology, the Ukrainians. So Europe and Ukraine has leverage. We just need to be cleverer. That's the reality, harsh reality.
What does repurposing industry look like?
Well, the Germans, used to be very good at making tanks years ago. Yeah, they went into cars.
Still pretty good. Yeah, precisely. So, well, no, that's it. So, is it cars for tanks? Is that how we should think about this?
It's as simple as that, but there's lots of new technology. I mean, it's interesting. Turkey is a country that could provide a stopgap solution. I mean, Turkey has a huge military, 800,000 soldiers, 400,000 mainstream soldiers. A huge manufacturing capability. They have particular skills in drones, for example. The Bayraktar drones, we saw that in the early period of the war, incredibly impactful. The Turks are desperate to work with us. They want our technology. They can give us their manufacturing capability to quickly step up. We need to bring Turkey in. It was very good that Starmer invited the Turks yesterday. We saw the foreign minister, Hakan Fidan, there. They're going to be central to anything that happens.
You say money isn't a problem. Is that actually the reality? Yes, ultimately the money will be found, but is it a zero-sum game? What gives? In the past, how has Europe financed these kinds of things? How are you thinking about the capability, the financial capability that is going to be required to make this happen, and where does that come from?
Look, I mean, as I said, we have $330 billion of immobilized Russian taxpayer cash in our bank accounts. We've done nothing about it for 3 years. Rishi Sunak, he was in office, did nothing about it, wrote a piece in The Economist over the weekend, we need to do it. He didn't do it when he was in office. Remember, last week the UK stepped up its defence budget, taking down the aid budget, right? We've got 25 billion quid in our bank accounts that could have been used to moonshot our defence spending.
But Europe feels squeamish about that, though, should they not? Should Europe not feel squeamish? Because it sets a precedent, doesn't it?
The ECB have been blocking it, and European treasuries. And the argument is, obviously, the reserve currency argument. I'll just tell Christine Lagarde, right? If Russia wins this war, there is no euro, right? I mean, and people like Lagarde should not be making this decision.
So should she be cutting interest rates to make it easier for governments?
Well, look, there's lots of ways you can do it. I mean, we look at COVID. This is an existential threat to Europe. it's like COVID. It's about our security. It's about our national defence. It's about rule of law, all those European values, right? If we care about any of those, we just need to find the money, and there are lots of ways to do it. Again, 27 trillion euro economy.
Yeah.
It's not difficult, guys.
So shake that magic money tree, Europe, is what you're saying, basically. Tim, I want to come back to the point you make about drones, because there's a question that's been bugging me all week. Given so much of the war is conducted by drone in Ukraine, and given that you've got Musk basically in the US government at this point, are you concerned that Starlink gets turned off in Ukraine and that affects the drone warfare?
No, absolutely, yes. The Americans have the ability to make life very, very difficult for the Ukrainians. I mean, I guess the hope, everyone's very negative about Friday's event, right?
Yeah.
I'm now looking a little bit more positively about it, interestingly, because, Ukraine faced a situation where Russia and the Americans would impose a solution, a bad solution, because the Trump administration really don't get Ukraine. They don't get the challenges, right? Europe was nowhere. Ukraine was nowhere. After this weekend, Ukraine and the Europeans are centre stage. The Americans, the Russians will have to take a back seat. It gives the Ukrainians the ability to actually put some of their mark on a peace process, and that means a peace will be more sustainable, in my mind. That's a positive. UK's back in Europe. Huge positive post-Brexit, right? Our soft powers have been massively missed, right? UK has to get involved in soft diplomacy and hard power politics, which is defence. That's positive.
It seemed like the spat in the Oval Office on Friday was more about the tone than the terms of the minerals deal, right? But the former UK Defence Secretary Ben Wallace has said that it amounts to extortion.
Yeah.
Do you think that Keir is kind of better off without that minerals deal?
Look, the minerals deal wasn't worth the paper it was written on. That's the reality. I've covered Ukraine 40 years. I've lived there. I've never heard of 12 trillion in rare earth minerals. It was genius for the Ukrainians to bring this up and entice the Trump administration in. But in the end, the Americans gave nothing. There was no commitment at all in that deal. No financing commitment, no security guarantees commitment. I mean, Ben Wallace called it extortion, But the reality, as I said, it got Zelenskyy in the room. It gave him... he could look in Trump's eyes and Vance's eyes and figure out, are these guys serious? And the reality is they're not. It was crystal clear, I think, for everyone in the White House that the Trump administration, Trump himself said it, I trust Putin, I don't trust you. So the Ukrainians now can figure out, OK, fair enough, the Americans are on our side, we need to move on. That's the harsh reality for Ukraine and Europe. We absolutely need to find a plan B. And actually, that meeting was crystallising in terms of forcing Europe into the peace process. That's a positive.
Why? OK, I trust Putin more than I trust you. There is this idea that America is being more friendly towards Russia because it doesn't want China and Russia allied. It basically wants to find a way of a reverse détente.
Yeah.
Is that how we should think about what is happening in terms of White House policy? Is there a big strategic vision here?
Yeah, well, I wouldn't necessarily put it like that. I don't think China and Russia are that close. I think the MAGA guys, the Steve Bannon, Tucker Carlson...
China?
Look, they see the coming war is between the US and China, and they want Russia on their side in that conflict. Trump himself, I'm not sure he thinks about this. He likes big, shiny deals, which is why the minerals deal kind of enticed him. And he wants a quick ceasefire deal. He doesn't care about the details, frankly. He just wants that Nobel Prize and other people can clear the mess up. But I think, yes, you're right there. I mean, I think interesting for the Americans, it's interesting they ally with a $2 trillion economy, Russia, and pushing out a $27 trillion European economy. I think that's very short-sighted. Europe will get its defence industries in order in 5 years. We will step up, and then I think the Americans will need to come back to us because Europe will be able to give the Americans the scale against China. And I said, Europe has leverage. We're just not using it, right? We should go to the Americans and said, big defence procurement deal and a long-term commitment to help the Americans against the Chinese. Otherwise, we need to look for alternatives. We actually need to be reaching out to China. And we need to be reaching out to the Gulf and the Turks to secure our own, diversify our own defence and security story.
Great to see you, Tim.
Pleasure.
Interesting angles. Tim Ash, Senior EM Sovereign Strategist at RBC Blue Bay Asset Management and Associate Fellow at Chatham's House Russia and Eurasia Programme.
Well, as we inch towards the open, we have Shell reportedly exploring a sale of its chemicals assets in the US and Europe. We'll bring you more details on that potential deal in today's Stocks to Watch. That's next. This is Bloomberg.
Welcome back. 7:48 here in London. This is the opening trade, Monday the 3rd of March. We're expecting European equity markets to go higher. Defence stocks certainly very much in focus. Let's talk now about the markets. Our Markets Live executive editor, Mark Cudmore, joins us now. We are pretty risk-on into, as you say, a busy week, Mark. It's a strange kind of risk-on when defence stocks look set to lead the way here in Europe.
Yeah, I am finding it slightly confusing how optimistic markets are generally trading. Tonight is the tariff deadline. I expect tariffs will be imposed. The hint over the weekend from Howard Lutnick was that they'll be imposed at a lower level. But I think that just the fact that we'll have tariffs imposed by the new administration on somewhere else besides China and close allies, the US, you would think is a risk negative. Now, maybe if they come in as low as 5%, markets kind of go, OK, it's going to be more gradual, less than threatened, and that means it's something we can deal with. Maybe. But I am surprised, given the risk events this week, that we are trading quite so risk on. And I say that as someone who is very, very constructive for global equity markets this year. Not the US. I do think we've at the end of US exceptionalism. So I think US markets underperform. But I think that global markets can do very well. But in the short term, I am nervous given the risk events.
Do you think there's a Trump put, Mark? I look at the crypto news over the weekend and I wonder whether that is the case. Crypto gets knocked pretty hard. Trump steps in. Could the same thing apply to the equity markets?
It certainly felt like there was a Trump put for crypto. I think there probably is a Trump put, but I just think it's nowhere close. I think in his last administration, there seemed to be a Trump put, but it was when the market got nearly 20% down. So I don't think the Trump put is on play for the stock market right now. I'm not a full believer in this new narrative in markets that the Trump administration actually wants the kind of growth pain they're getting at the moment because they're focused on getting yields lower and that'll help their overall definancialization of the US economy and help their long-term goals. Take the pain now and then turn it around in time for the midterms. I'm not a full believer in that, but I'm open-minded to the fact. And I certainly think that the administration are more willing to take short-term pain than I think many people were originally thinking about only a month or two ago.
And Mark, in terms of the response to the tariff story, do you think that markets are too pessimistic about the NPC meeting this week?
It's really hard to know on that one. I think this is another very, very big event. But the history of the last few years in China is a lot of promise and then ultimately underperformance on the kind of the delivery and the concrete measures. Now, as you know, I think last September was a real game changer, a real turning point for the longer term China narrative. And I think it's Hong Kong stocks are the more value way to play it. And that's that they are aware they can't have too much markets pain. I expect that the NPC will not impress the bulls out there, but I think they'll deliver enough to not, feed the bears. So I think it'll be kind of maybe a mixed measures, maybe a little bit disappointing in the short term, but it'll continue the narrative that they're providing structural and sustainable gains for the Chinese markets, and they're helping the economy at the margins slowly escape deflation and kind of remove some of the debt overhang that's there and make it sustainable for the long term.
Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Now let's get to your stocks to watch with Joe Easton from our equities team. And Joe, it looks like it's going to be a massive day for these European defence names.
Absolutely, Lizzie. We're seeing some huge moves on the Tradegate exchange this morning for some of these defence stocks. Some of them seeing double-digit % rises in these early moments of trading on that German exchange. Then JP Morgan out with a note already saying that the news over the past couple of weeks has really turbocharged the earnings story for this sector, and they do expect to see continued increases to consensus estimates and also a further rating for a sector that's already risen 40% this year alone. So JP Morgan out upgrading their price targets across the sector, around a dozen stocks, including BAE, Rheinmetall, Dassault Aviation and Leonardo. But all of those stocks set to surge this morning as defence, the key sector in focus. Then in terms of other single stocks news, we've got a bit of news coming for Shell. They are potentially going to be offloading part of their chemicals business. This is a report in the Wall Street Journal. That has been the outperformer versus the big rival BP. So potentially this is going to support that trend for Shell. And then in the aviation, we can see there not a single sell rating on the Shell stocks, so clearly a favourite on the street. And then in terms of aviation, we have got news potentially Airbus seeing a bit better sales in the last month, according to a consultancy, after the firm fell behind Boeing in the last month, so potentially going to see a bit of a rebound in their orders, according to that report. Airbus could be in focus, but again, a bit of a defence read across potentially. In terms of analyst ratings, AB InBev up to buy at Deutsche Bank. And we've also got Dassault Systems in software, that's to buy at Berenberg, and Novo Nordisk getting a cut to stifle in terms of your pharma stocks. One to watch in Copenhagen this morning.
Thanks very much, Joe. Our equities reporter, Joe Easton. And I suppose with all of the news of the weekend, trying to cut through all of that and think what happens to defence stocks, I was genuinely wondering how much was priced in already on that news, because we seem to have been talking about defence stocks so much year to date, haven't we? And yet we sit here and see these suggestions that the market will be much, much stronger at the open.
It was really interesting listening to Tim Ash talking about the fact that we've got 5 years basically to build up our defence infrastructure. That's going to place huge amounts of strain on the balance sheets of these companies. Yes, there's going to be, the top line is going to move, so there's going to be orders. But what happens to the rest of these businesses as they try and expand? They've got a real job on their hands if they're going to deliver upon this. Yes, there's this kind of future of bigger orders, but to get there seems actually quite hard.
Because it's so difficult to match the pace of innovation of Ukraine, or for that matter, Israel. Nations that are on the battlefield. 5 years is a long time.
It is, and a huge strain on the balance sheets as we get there.
Yeah, absolutely. We'll see how the markets open up this morning, Monday the 3rd of March. Then expectations, we will go higher, led by defence stocks here in Europe. We'll bring you that opening trade. This is Bloomberg.
Monday morning, a lot of things happening this week, a lot of things that are going to be factored into the market as we work our way through the next 5 days. But let's take a little bit of a history lesson. Let's think about Friday. Ancient history, it seems, certainly judging by the news over the weekend and how much of an impact it's going to have. But let's talk about where Europe went out here in terms of the US session. Look at the US rallying after that. That's a story that we need to fold into the European futures picture this morning. We've got so many others we need to think about as well. Defence stocks, front and centre, Lizzie.
And that, Guy, is why you are expecting to see outperformance for the DAX this morning. The likes of Rheinmetall expected to have double-digit increases this morning, but all of European futures in the green on the expectation of that increased defence spending. Anna, you're looking at some of the other individual stock movers at the open.
Yeah, absolutely, but just lingering unapologetically on that trade in defence stocks this morning, because it could be where our focus really lingers. Just worth pointing out that Rheinmetall already up 64% year to date, and that's before we see what happens today. Leonardo already up 49%. SAAB also already up 37%, so we already have a lot of tailwind behind these, but there seems more to go. Shell, very much in focus. Wall Street Journal carries a story over the weekend about whether that business will look to offload its chemicals infrastructure, part of it at least. That seems to be a focus there. Airbus, also an interesting one to watch. We've seen one particular consultancy coming through with some guidance suggesting improving output from that business from a rough January, so we'll continue to watch that one with interest. And as Joe mentioned, read across from defence, of course, there as well. Guy?
Think about Airbus. Airbus is a combination of Europe's civil aviation assets. You wonder whether or not we need to create now Europe, an Airbus for Europe in terms of the defence space. That's an interesting way of looking at that narrative. Let's talk about what is happening with this European Open. Here we go. We're going to get some numbers. BAE Systems could be the standout story in the FTSE 100. It opens just in positive territory, expected to climb from here. We're expecting many of these markets to be open up kind of, let's call it circa 0.5%, but we'll see where the rest of the session takes us. Remember, we've got US manufacturing ISM data coming out a little bit later on. That's a key number to watch out for too. So the stock 600 is up as well. We'll see how long it takes Germany to open this morning. We'll see how long it takes the French market to open. We need to get an idea of how some of these single defence stocks are trading this morning. There's other factors going on around it, but that story, that geopolitical story, absolutely front and centre this morning, Lizzie.
Yeah, so we are waiting for the likes of Rheinmetall, Leonardo to open. We have got Safran shares up 2.7%, Airbus 1.5%, Indra Sistemas up 3.9%. And as we continue to wait for some of the CAC and the DAX, just at the moment, the sector breakdown is about half in positive territory, utilities in the lead and tech at the bottom of the basket.
Yeah, see, Rolls-Royce has opened up by 4%. I think not quite as aggressive moves to the upside then as perhaps some of the suggestions an hour ago or so that we were seeing coming across from TradeGate. But that's what we see right now. We're waiting for some of those big names, as you point out, in the energy space to open up. And in terms of the other trends that we're seeing from a sector perspective, then energy is the best performing sector this morning.
Just a quick note in terms of luxury, because, of course, we did have the scoop on Prada looking to buy Versace. We'd already seen those shares higher 4% in Hong Kong. You are seeing red on the screen for the likes of LVMH and Kering. Does that new addition to Prada help to compete with those big luxury names?
I would be surprised if they were trading down on that. They're such heavyweights. There's a kind of index angle maybe to some of this as well. You have seen potentially some of that feeding through into the market over the last few days. If you're buying is there a portfolio effect here? If you're going to buy European defence,
get rid of luxury.
What are you selling? Kind of what's the other side of that trade, I think maybe is what we need to think about in terms of the narrative here. We still don't have a trade on the DAX. Be interesting to see exactly how much the DAX is going to open up this morning and which are the key stocks that we're going to be watching out for. I'm just going to scroll down and see which ones we're still waiting for. Rheinmetall has yet to open, but as we've already indicated, that stock has been up really very, very sharply since the start of the year already. Elsewhere, some of the industrial names are up. Siemens Energy, Commerzbank, Daimler on the upside. But Ollie, who joins us again around the table, Ollie Crook, waiting for Rheinmetall.
Yeah, listen, we're going to wait for this to open up this morning. I mean, listen, I think we were all a bit surprised when we were looking at the desk of the TradeGate pricing for the defense story in Europe, where we're seeing double-digit calls to the upside after what we can say is probably we would have thought has already been priced into the system. I think that what is interesting about this is that trying to find, we're getting the opening price now on Rheinmetall. I'll just pull that up now if we've got it. So up 13%. Yeah. So, again, when we're talking about, you know, kind of the defense military buildup, potentially after what we saw on Friday, there's some real credibility to all the words we've been hearing for the last few months, where now the market is really beginning to price in. We're hitting almost 15% now on Rheinmetall. Really, I think the bellwether of sort of European military build-out really does, you know, a company that does really a great deal in that space. But again, it shows to show that there is still legs to go. The question is, how are you going to actually finance this stuff? What are the actual mechanisms going to be? And that is going to be what's going to be thrashed out over the next couple of days. And certainly in Brussels, you need to come up with something because the rhetoric is not going to buy the bullets.
Right, yeah. So we have Rheinmetall up, as you say, 14%. SAAB now up by 11%. Rolls-Royce, as we mentioned, up by just over 3%. You were taking sounding into the weekend, Ollie. We've had a lot of conversations during the weekend, of course, about where the defence story for Europe goes. Take us to the Norwegian angle here.
Yeah, so listen, I spoke to the Norwegian Prime Minister a few hours before that meeting in the Oval Office, got on a plane. By the time we landed, all of this stuff had happened, and just trying to get our head around the story of, you know, basically what had happened in the Oval Office. But what's interesting is Norway is, of course, not part of the EU, but they want to start to build closer ties with the Europeans in terms of coordinated defense procurement. He was very open to this idea. But what I thought was interesting is also this sort of idea of the coalition of the willing. This is not just about putting troops on the ground in Ukraine. This is, of course, one component potentially in terms of the security guarantees. But it's what is this new sort of architecture if the NATO of the past is not what we sort of anticipated to be? And this is something that's going to involve, obviously, you know, Norway with this massive sovereign wealth fund could be a large component of. But, of course, Turkey. We're talking about the largest standing army within Europe. This is an absolutely huge sort of part of this. So have a listen to what he had to say to us on Friday.
Europe cannot complain its way to the negotiating table. It has to argue its case on substance and on process. And it would be easier if Europe spoke more with one voice. And Europe on Ukraine is not only EU. It is EU, it is UK, it is Norway, it's also Turkey.
So trying to develop this new architecture. What I think is interesting, though, I did press him on, is it time to start withdrawing some money from the Sovereign Wealth Fund to start funding European defense? He said, no, we're not really ready to go there. Is it time to commit troops to the peacekeeping operation in Ukraine? He said, no, we're not quite ready to go there. Is it time to think of the Sovereign Wealth Fund not just as something that needs to net the highest return, but as potentially a geostrategic tool to try to build out the European defense ecosystem? He said, no, we're not ready for that yet. The question is, with these Europeans, will they start to begin to think outside of the box and really challenge themselves? And that, I think, is a big question for Friedrich Merz, who's about to become Chancellor of Germany.
OK, Bloomberg's Oliver Crook, we thank you. As we see the DAX higher 0.7%, the CAC open 0.3%. We can get more analysis now with Karim Shadid, head of EMEA Investment Strategy at BlackRock. He joins us around the table now. Karim, we were just talking to Ollie about the European defence spending, the rise in the likes of Rheinmetall and SAAB, double-digit growth this morning. Do you think that the picture is really that different from Friday to justify this sort of a jump?
I mean, I think the story in Europe has been building for the past couple of months. Like, we just closed February, and we've seen a second month of European equity outperformance. And what I would point to, actually, is a poll that we did on a call with our clients across Europe. 405 clients answered that poll across Europe of what do you think are the biggest drivers of European equities right now? And 50% said geopolitical developments, 30% said valuations, and only 20% said macro or micro developments. So to me, the story right now is a European equity rally that is reflecting a reduction in risk premium priced in by the market on geopolitics as one component, as well as, you know, sort of the early innings of macro as a second. But it's still not a fundamental rally yet. Maybe that's leg two.
So then we look ahead to Thursday, and you've got two massive events, the ECB meeting and this EU special summit on military aid for Ukraine. Seems obvious. Which is more market moving?
Well, it's a great question. I do think the rate divergence, the central bank divergence of the ECB and the Fed is one that we have been talking about from the get-go, from the start of this year, as sort of an important macro theme that investors need to contend with this year. And so I do think the ECB meeting does present a tailwind. We do expect a rate cut. The inflation figures end of last week, to your point of what's changed between Friday and Monday, you know, we had a few single country inflation figures on Friday that did point to further drops in inflation. We're expecting the composite number today to point to this, which should provide, you know, enough support for sort of continued rate cuts, which is one of the tailwinds for European stocks.
Are European equities decoupling from American equities? If US equities went down 10%, I keep asking this question, would European equities go down 5% or 15%? I still don't know the answer, because it feels like this morning we're decoupling. But is that still the reality? Can we divorce ourselves from what happens on Wall Street?
I think it really depends on what's driving that sell-off. European equities are more geared towards growth and towards international trade. If you look at the Stoxx 600, 60% of revenues come from outside of the EU. That figure for the S&P 500 is under 30%. So European equities more exposed to trade and to growth. So if the sell-off is driven by significant growth fears, then I would say they're not insulated. But if the sell-off is driven by specific concentrated risks around concentration in tech and so on, then Europe is a diversifier.
Is a rearmament story, is a Europe moving into a different phase, inflationary or deflationary? Because it feels like, I talk to the civil guys in aerospace all the time. They're telling me they've still got massive supply chain issues.
Yeah.
And that they're still struggling to find the stuff they need. If Europe is about to embark on a major industrial program, is that inflationary? Is that something we need to think about and fold into our thinking? Because at the moment, as you say, the narrative is deflationary, disinflationary. Could that be about to shift?
I think there is enough disinflationary force in Europe, although I wouldn't read too much into the drop in the inflation figures last week. I don't think the ECB is going to go even further because of those. To your point, there are some inflationary pressures as well when it comes to spending. If you look at the Bund curve, for example, that hasn't been exempt from the term premium, from the steepening of the yield curve that we've seen in US Treasuries as well. Those bonds have been correlated, to your point. So it's a bit of a mixed bag. And the way that we're investing in this is we like European credit. We like European high yield. We're somewhat preferring European duration because less inflationary pressure in Europe compared to the US. But we still do look at yield curve steepeners even in the bond curve.
Karim, so you're talking there about relative inflation pressures and where they are on either side of the Atlantic. But to pick up on Guy's point, I mean, if rearmament maybe is going to add some inflation in Europe, there are plenty of other trends you could point to that also sound, at least at headline level, to add inflation. So decoupling, reshoring, maybe more nationalism globally, all of this sounds as if ageing populations. I wonder what role technology, though, plays in our inflation conversations, because in the great moderation, inflation, tech played a big role in keeping inflation down. And I wonder whether AI does something similar or not.
It's a great question and one that we debate a lot because we identified 5 mega forces at BlackRock, and this has been a few years now. So it's not none of those 5 mega forces were created this year. We gave them names 3-4 years ago now, and so they included the aging demographics that you mentioned, which are all else equal probably more inflationary because of the supply chain tightness. They included things like the transition to net zero, which includes a lot of spending, can be somewhat inflationary as you electrify the economy, and includes also artificial intelligence. And artificial intelligence requires a lot of spending in the next few years. We forecast the spending required to double on data centers, to double between now and 2030. That can be inflationary, all else equal. However, you have the productivity boost, which is ultimately disinflationary over time. And that productivity boost, depending, and this is a moving target, the analysis, but depending how quick and how big it is, will be the offset that we need for all the other inflationary forces we're talking through.
Okay, so that's where that one falls into place. So all of that said, then, where are you looking ahead for 2025 in Europe with enthusiasm, Karim?
So we generally, we just upgraded European equities to neutral last week from the BlackRock Investment Institute. We're generally leaning into that European trade, which, as I mentioned, referencing the poll that I shared at the start, is still right now in that first leg of reduction of risk premium priced into European equities, which can have a bit more legs to go. For that next leg, we want to start seeing earnings pick up. Earnings did better than expected this season in Europe, but they're not as good as the US. We want to see them pick up to get a bit more fundamental backup to the European trade. Sectors we like: luxury, banks. Those are two sectors that we look at in Europe.
But are you not a bit late to that party with European equities? You know, just upgrading them to neutral now. This is the point where some of our other guests are saying, or had been saying, get on them, and are now stepping away from them because they're saying they're overbought.
So, we have been talking about European equities for a few months now, but we've been highlighting the opportunity in active strategies. And, I've done this, I've shared these thoughts here on this program for a few months now, but this idea that dispersion in European equities is at the highest it's been since 2009. That has to say something. It says that stock picking in Europe works, and you can generate good alpha by going active. And that applied a few months ago and still applies today.
Karim, great to see you. Thanks for stopping by to see us. Karim Chidid, Head of EMEA Investment Strategy at BlackRock. Thank you very much indeed. Let's take a look at the Core 6, figure out what is happening out there. Not many defence stocks on this board, but let's show you what is happening in terms of some of the more heavily weighted stocks here in Europe. Generally softer this morning. Farmers down, luxuries a little bit lower. Interesting that tech's catching something of a bid. But as we've already indicated, the story really is what is happening in the defence space right now. Europe over the last few years has been known for some of its luxury names, a few tech names, but not many. Defence stocks have underperformed. That is changing rapidly.
Coming up on the programme, we head to Milan as Fashion Week there draws to a close. We'll discuss what Prada's potential purchase of Versace means for European luxury. We'll have more on that sector when we come back. This is Bloomberg.
Welcome back to the opening trade. 17 minutes into today's session, and European equities racing ahead this morning. Particular outperformance on the DAX, though not so much movement when it comes to the European bond space. In terms of the sectors, it's the industrial goods and services that are powering ahead this morning, up 2%. But in terms of the individual stocks in defence, much bigger moves. Let's go to Joe Easton with those individual names.
So we are seeing some incredible moves in the defence sector today, Lizzie, given the weekend news flow, seeing double-digit gains across the big firms. BAE Systems up 17%, Rheinmetall up almost 16%. These stocks all seeing their biggest intraday gain since the war broke out in Ukraine 3 years ago. Bear in mind, BAE started this year trading at £12. It's now at £16. Rheinmetall, almost 1,200 on that stock in terms of euros, traded around 200 euros a piece before the outbreak of the war in Ukraine. And as we can see there, we've brought a second board up in terms of some of the other movers. 15 out of the top 20 stocks in Europe today, all in the defence stock. Clearly the biggest driver of the market moves today. Massive jumps. Some of these smaller ones in the UK as well, getting a boost as well. SAAB in Stockholm up 14%. Incredible moves following all that news flow over the weekend. And also a couple of small indicators in terms of some of the underperformers are the ones exposed to Ukraine and Russia. Raiffeisen Bank, a company that still has a big bank in Russia, and also Ferexpo, a miner that is based in Ukraine but trades in London, weaker, potentially showing us the sentiment on those market moves today in terms of all of the stories that we saw breaking following that meeting between Zelenskiy and Trump. Then in terms of Airbus, we did get news of potentially a rebound in some of their orders in the last month, though also, as Guy was mentioning earlier, this is also a bit of a defence read across, given Airbus does have some defence exposure as well, but nonetheless getting a boost on potentially higher orders in the last month for Airbus. Then in terms of Shell, looking to possibly sell part of their chemicals business. This was in the Wall Street Journal, continuing the strong year-to-date we've had for that company, outperforming the big rival BP, of course, being the main rivalry on those ones. Getting a boost this morning, up around 1% for Shell at the moment. Then finally, on the ratings changes, Deutsche Bank upgrades AB InBev to buy, potentially going to be buying back $30 billion worth of stock in the coming years as they get a rebound on sales in both the emerging markets and in the US. It's a lot of Stella Artois that they're selling at the moment and returning that to their shareholders. AB InBev edging higher, up 0.4% this morning.
Joe, thank you. Joe Easton from our equities team with a rundown of some of those stocks that are moving. Now, we're closely watching what's happening with European luxury stocks this morning. We're actually seeing a little bit of weakness in that sector. Is that driven by a pivot into defence stocks, or is that related to some of the individual companies and their news flow? Also hanging around that sector, luxury stocks watching very carefully reports that Prada is said to be moving closer to some M&A deals, to a deal specifically to buy from... well, let's get an update, shall we? Because I can't make any sense of what's in front of me. Joining us now from Milan, our Bloomberg Bureau Chief, Tommaso Erpart. So some M&A in the offing, Tommaso. Tell us what's at stake.
Yeah, it's we broke news last night that Prada is getting closer to the acquisition of Versace. The two companies, Versace is owned by Capri. The two companies somehow agreed on a valuation which is getting close to 1.5 billion euros. Versace was bought in 2018 by Capri for 1.8 billion euros. It's a very interesting and somehow iconic deal. If it happens, it will put together two of the house of names of the Italian fashion industry, and for Prada will be clearly a big acquisition, probably its biggest acquisition since about 25 years ago, and it shows that Prada want to remain independent in a luxury sector which is concentrating among bigger players.
Obviously, we've seen consolidation in this industry over the last few years. Is this another example of that? Is this the formation of another big group? Obviously, it's tiny compared with some of the massive giants like LVMH. But what does this mean for the wider luxury industry? Are we going to see another phase of consolidation?
We are seeing for the first time in several decades a consolidation in Italy. So this is probably the beginning of an Italian bigger fashion group able to compete with the French rivals. Clearly, Prada on the stock exchange in Hong Kong now is worth about 21 billion euros. Close to carrying, but less than 1/10 the value of LVMH. It's a reverse of a trend. That would be for the first time you will see an Italian iconic brand be bought by a domestic player and not by a foreign one. So it's a big change for the fashion industry, for the luxury industry, especially in Italy. We have to see, as we reported last night, they agreed on valuation. They get it closer to a deal. The deal is not done yet, but it's getting really close.
Morning, Tommaso. Lizzie here. So maybe a win for Italy after the losses of Gucci and Valentino. But as we look ahead to Prada's full-year results, what are you expecting there?
Prada is incredibly resistant to the downturn of the luxury industry. Analysts are expecting another very strong quarter. Its sister brand, Miu Miu, is clearly doing results which are much better from the rest of the industry. It's double sales in the third quarter and has a potential to boost its revenue from about 1 billion to 2 billion, according to analysts. So Prada is going to show likely very strong results, and so it's time probably to do a bold acquisition to put together its minimalist style with the maximalist side of Versace. So are two brands which can be complementary because they are very different.
Tommaso, great stuff. Thanks for the story. Thanks for breaking it. Tommaso Eppard, Bloomberg's Milan bureau chief, joining us on a deal potentially you could see play out over the next few days. Let's talk quickly about crypto. Surging yesterday, circa 4 o'clock UK time. See a big rally coming through. Donald Trump obviously at the epicenter of the action, once again talking about this reserve that they could set up in the United States. We're fading that move a little bit this morning.
Yeah, absolutely. So Bitcoin down by 2.7%, Ethereum down by over 6% this morning. So it hasn't necessarily, I mean, we haven't unwound all of those gains, but yeah, that sense of enthusiasm over the weekend certainly waning.
Yeah, so not actually going closer towards that last record, which I would note was $109,000. We look ahead to this crypto summit that's happening on Friday at the White House. So Trump hosting the first one ever. What a turnaround, you know, from the days when he used to call crypto a scam. But likely to see founders, CEOs, investors there talking about, you know, regulation and opportunity in terms of crypto ahead.
Do we actually get details, though? Because yesterday was great. Yeah, we're gonna do this, but actually once you dig into the details, there aren't many of them.
Yes, because there's sort of drip feed.
Yeah, is the US going to be buying any more? Is this just the existing confiscated plus other kind of sources of Bitcoin and other coins as well? Is there going to be anything new there? Is the regulatory environment really going to change that much? I think it's interesting that this morning's fade maybe does indicate a little bit sort of degree of scepticism.
And I think at some point we need to have a conversation with somebody about the purpose of a strategic digital assets reserve, because at the time that this was first floated, I know some of our colleagues who follow this market very closely, citing a lot of people saying, well, this will do well for the people who have already got exposure to crypto, but does it perform any wider strategic purpose and function? We'll certainly follow that one and ask those questions.
Cue a joke about the fears of the gold going missing at Fort Knox.
Yes, probably easier if we're talking about crypto. Anyway, we'll come back. OK, what do we got next? Let's talk about what is coming up. We need to get back to this geopolitical story that is moving stocks so much this morning, particularly defence stocks. Huge gains being generated with the names of, with the likes of Rheinmetall and BAE Systems up strongly. The UK Prime Minister, Keir Starmer, telling European leaders they need to get real about defence spending. We're going to discuss security funding. How do we deal with the gap in funding? Well, our next guest, Rob Murray, the former head of innovation at NATO, joining us to talk about a defence bank in Europe. Is this one of the potential routes that we could be talking about? We'll discuss that next. This is Bloomberg. We're 30 minutes into the equity market session here in Europe. European equities at a headline level, as you can see, actually not doing a great deal. But below the surface, there is significant activity that is worth paying attention to. In particular, we are seeing a big move in defence stocks this morning.
Yeah, absolutely. Let's bring that to you, show you that surge that we're seeing in defence stocks following EU leaders meeting Ukraine's Zelenskiy and pledging further support to that country. With European leaders contemplating options to increase their defence capabilities, one possible route being proposed is the creation of a global multilateral bank to fund that defence spending. The Defence Security and Resilience Bank, the DSR, announcing today is aiming to close the funding gap they believe is threatening Western security. With us now is Rob Murray, former head of innovation at NATO and the bank's founder. Very good to have you with us, Rob. Thank you for coming in to speak to us. So this is all about setting up a multilateral institution to help Europe fund its defence spending. You haven't come with a NATO background. There seems to be plenty of people listed in this who maybe also have some NATO experience. Is there a role for the US? Are you assuming any involvement in the US in making this funding model work?
Yeah, it's a really good question. And, fundamentally, what are we trying to solve for? What's the problem we're trying to solve for? First of all, we've got to get significant levels of money into nation states so that they can spend on defence. That's really clear, and it came out yesterday. It's very clear, and I think we're going to hear more of that later this week. But even if we do all of that, the second challenge we've got to figure out is how we can spend that money, get that money through Ministries of Defence and contract it out. And even if all of that happens, we've then got to be able to scale up the production capacity for then actually companies to invest all of this. Now, when we think about production capacity, the United States is where significant levels of industrial defence production capacity exists. So any sort of multilateral bank that is going to support European defence and also actually support American activity as well economically, has to involve the United States. And the United States is very much open to this idea based on discussions we've had.
Oh, really? So you have had... Because I was looking at anchor investors, the wider membership group that you're proposing. Have you had conversations with the Americans that suggest they would participate? Because the mood music around NATO is not quite so positive.
No, you're right. I mean, look, it would be the geopolitical situation we are in right now. I was in Munich a couple of weeks ago, and it's very clear to see. So that's a clear point. I think because of the economic upside for the United States on this sort of activity, that they can see that actually, this makes sense. So to put that into context, when we think about all of the intra-exports of defence across the NATO alliance, about 55% of that comes from the US. Roughly 10% from France, 10% from the UK, 10% from Germany, and the rest is distributed. Now, the point being is that distribution's probably not going to change that much, not really. The pie is just going to grow bigger because we'll be creating a financial instrument, a bank, to be able to spend more on these things. And therefore, the United States is going to be quite a significant winner from such an approach. And that's recognised with the conversations I've had with folks in Washington.
Why do we need a bank? Why don't we just issue lots of debt and give it to the MOD?
Well, Guy, that's a very good question. And the way I see this is it's not an or. This is an and, right? I think it's a package. And I think that we're going to have to see new architectures drawn. We've got a new systemic challenge we're facing. There's about 40 multilateral banks globally, World Bank, European Investment Bank, etc. None of them have a mandate for defence and security. And so we're going to have to create one in order to perhaps support some of those efforts I talked about. But joint debt will be part of this as well. Also, we need to understand the markets in this. So I think if we're to solely look at the way in which debt instruments are issued for bond markets, then I'm not sure the market can take all of that. But a multilateral with a AAA rating, that's a slightly different story. But I want to emphasise the point, though, that there's going to have to be a suite of tools, financial tools issued.
I spent a lot of time talking to civil aviation companies, and for the last few years, their biggest challenge has been not at the OEM level, not at the SAAB, not at the kind of Rheinmetall level. It's been further down the supply chain. And the issue there has been that these companies have not been able to get the finance they need to invest in the ramp that Airbus and Boeing and other companies have been talking about. As we look to scale European defence, is that where actually the biggest challenge comes? It's not in the kind of OEM level, it's the Tier 1, Tier 2, Tier 3 suppliers. Is that the problem maybe that the bank would help to solve as we accelerate this ramp into defence spending?
Yeah, you've really hit the nail on the head there, because fundamentally, going down that supply chain, going down to those smaller companies you highlight, that is where they struggle to get credit. And this is really a combination of factors to do with compliance predominantly. So it's been a compounding effect of ESG rules, of know your customer rules, of anti-money laundering law rules. These have all kind of compounded on each other. And so if you're a small company in that supply chain and you go to a bank and simply say, we'd like to open a bank account, we'd like to have an overdraft, very simple banking services, they're not able to do that because, or it's very difficult to do that because of the compliance risk. A multilateral bank, like the DSR Bank, Defence Security Resilience Bank, will be able to provide guarantees to those commercial banks to help deal with that risk. And therefore, that credit crunch that we see at the moment in the defence sector, as you described, that would dissipate because you would have the backstop of those guarantees from a multilateral. And that's the beauty of this sort of approach.
Do you think the bond market would be more willing to absorb some of this if the focus were on European companies and some of those supply and capacity issues could be solved and more of this money was going to European firms? I know that that's not going to get solved overnight. We've talked already about US defence companies and their capacity. But do you think if it had more of an upside for European economic growth, it would help?
Yeah, and that's a really important point because let's take a slight step back now. Let's just imagine that we're going to do this Europe only, in this sort of approach. The bottom line is we just don't have the production capacity. So even though we're seeing the market reaction this morning, we're seeing those numbers go up, in terms of actual speed, everything's about speed now. It's about speed of production. And we simply don't have that. We have to be able to build that capacity. So therefore, we want to be able to do two things at once. We want to be able to work with the United States and, quite frankly, other allies around the world as well, where there is that production capacity, be able to build up, get the actual equipment and armaments and so forth into Europe, whilst also building up Europe's production capacity. And that is why the DSR Bank, with the way it's modelled, will be able to actually achieve that.
So what is it that you spend on? Is it drones? We were talking about the threats to drones. If Starlink, for example, got turned off in Ukraine, where do you put this investment?
Yeah, so, I mean, this is important because actually what you're really getting at there, Lizzie, is that how are we thinking about warfare? And the risk here is that when nations use the money that's going to be coming to them, in whatever flavour that happens, and the DSR Bank should be one of them, is that they look at legacy, they look backwards. And the most advanced army in Europe right now is Ukraine.
Of course.
Right? And therefore, there has to be, what we're really getting at now is we're really saying to the military, right, that the character of conflict is evolving, it's changing. You have to make sure that what's being acquired and procured reflects that. And that then gets into the really thorny issue of procurement. Defence procurement, having spent a decade in Brussels, having seen this, is a mess everywhere. And so one of the beauties of having a multilateral bank, back to your question, Guy, why a bank, is that you'll be able to put covenants and conditions into the loans. So what does that mean? It means that if country X wants to buy whatever technology it is, it'd be like, OK, great, that's fine, but you've got to make sure it adheres to these technical standards. It's this level of interoperability, and the whole deal's done within X years. And if you don't do that, then you're going to be on the hook to an international financial institution financially. That will start to nudge the culture of defence procurement and start to move at the speed of relevance.
And what's the role of something like the European Investment Bank here? Have you had conversations in Brussels about tying up with that institution?
Yeah, absolutely. I've had speak to the EIB folks quite regularly on this. It's really tough for the EIB because there's been a huge lot of political pressure on them for quite some time to spend more on defence. And there's been a sort of drip approach with regards to expanding this definition of what's called dual use, and what that means and so forth. The reality, though, is that for the EIB and for all multilateral banks, they're governed by their charters. Their charters are international treaties. And therefore, if you want to change it, you've got to open it up. If you open it up, just to add in a sentence, you've got to open up the whole thing. Yep. And then it's got to go through parliaments to be ratified. It's not realistic in the time frame we need. And so the EIB is a phenomenal institution, and they are a big proponent of what I'm proposing because they understand that it complements their work and their activity, and it's definitely not a substitute.
How does Europe get better at defence procurement? Is it at a national level? Is it at a programme level? Is it at a corporate level? Where's the easiest alignment going to happen within those areas?
There's a lot of views on this. My personal view is that I would love to see... We've got to think, again, take a slight step back. Why are we doing procurement? We're doing procurement to get stuff into the hands of end users, of operators, of soldiers as quickly as possible. So if the time comes, they can win. Right? Sure. It's about, and so the point being is how best to do that. Decentralisation is huge. What we've seen in Ukraine with procurement is we've seen commanders, brigade commanders, COs, commanding officers of units, actually having empowerment to procure at a local level, and not just little items, but major armament pieces.
That's true, but I talked to Guillaume Faury about this. The US has 4 helicopters. Europe has, I don't know, 24 helicopters. How do we get to the point where actually there's a commonality that exists that allows scale to happen in key programs? I hear what you're saying about local commanders being able to buy individual pieces of kit, but big programs like Black Hawk helicopters, etc., we need to figure out a way of doing that.
It's a tough one, because on the one hand, you could say, all right, let's be more standardised, let's have a much more coherent approach across the alliance and across Europe to do that. And there's efficiencies that come with that. Of course there are. I suppose the risk of doing that is you lose resilience. Right? And because if you're going down, if you've got, let's say for argument's sake, one type of tank, one type of helicopter, one supply chain that does all that. Yes, it might increase speed in terms of procurement, but it becomes very brittle, right, in terms of actually how these things are manufactured and made and at a resilience level. I think there's also a competition element to here. Talking to the Swedish Defence Minister a few weeks ago about this, and he was very keen that, no, we must have competition. Now, personally, I think what is the real issue here is the manner in which things are procured, the manner in which things are bought. And I think we have to have a much more joined-up approach on that. NATO has a procurement agency. Nations should be using that more because that provides that coherence. Equally, there's a very good paper out of Bruegel, the Bruegel think tank by Günter Wolf, that talks about this as well, about having more centralisation of how procurement takes place. Exactly who delivers it, okay, I think we probably do want a little bit more competition in there, but you're absolutely right about interoperability. It'd be madness to have all load of stuff that doesn't function together. And that goes back to how the Ukrainians have done incredible work over the last 3 years or so in actually solving for that problem. And we have to have the strategic humility and awareness to learn from that.
OK. Rob Murray, former head of innovation at NATO and founder of the Defence, Security and Resilience Bank, on how we can rip up the rule book and solve this defence spending issue. Let's get another voice on this now. Finland's president says that Russia must be countered with strength, otherwise it won't stop with Ukraine. Alexander Stubb spoke to Bloomberg's Francine Lacroix.
Well, sometimes public diplomacy doesn't work, but in these kind of situations, I think you have to be Finnish. Take a deep breath, take a cold bath, sauna, breathe, get back to the negotiating table. These things happen sometimes.
What's the way forward?
The way forward is to get President Zelenskiy and President Trump to communicate again and to get a minerals deal. I think that'll probably be a tipping point for a bigger deal towards a ceasefire and then towards peace negotiations. I don't think we are as far away as probably the public indicates.
We heard from the NATO Secretary General that it is up to President Zelensky to repair his relationship with President Trump. Do you agree?
I think it always takes two to tango. Sometimes what happens in marriage or in other types of relationships, you sort of go into your corner and sulk, but you have to come out of there, have a conversation, shake hands, and move on.
And do you think we're close to that point?
I hope we're moving. I mean, I think one of the things that we're trying to do in London with this summit organized by British Prime Minister Keir Starmer is to get a reading of the 3 meetings that were held with President Trump last week, take the best parts of it and find a way forward.
What does Europe need to do now, though?
We need to have a plan. One of the problems is that we have sort of this cacophonic diplomacy. We have different types of groupings and organizations dealing with different types of things. If we want to have an initiative, there needs to be a European and Ukrainian peace plan with which we can then talk with President Trump and later on with President Putin.
What is your message today?
My message today is that we need a plan which should have 3 phases. First, what do we do before the negotiations start? In other words, put Ukraine into a position of strength, give them military, political and financial support, and put more pressure on Russia, sanctions, and use the frozen assets. And then find some kind of security arrangements where Ukraine takes the lead, Europe supports, and the US provides the backstop. That's stage number 1. Give that as a plan. Stage number 2 is a ceasefire, and stage number 3 is actual peace negotiations. We just need to put things together, and I think we are in the right direction to do that.
President, who speaks for Europe?
Good question. I think the late Henry Kissinger once said European foreign policy is all a good thing, but who should I call? Right now, there are too many phone numbers. If it was up to me, I think we actually need a European special envoy. It can be 1, 2, or 3 people. I don't care. We probably need to have the big states here. So I think it's good that France and the UK are taking leadership here. I'm also hopefully glad to see Germany with skin in the game at some stage. So many different possibilities. But the problem that we have in the European Union right now is that we have 2 countries in the form of Slovakia and Hungary, which basically have a different view on Ukraine. The rest of us are friends of Ukraine. So the leadership of Europe right now is a coalition of the willing, and most of the countries are here in London today.
How optimistic are you about Europe's ability to stay together?
I'm very optimistic. I actually, I'm an EU nerd. I've been that for 30 years, and I've never seen the European Union more united. Actually, for the past 10 years. It started with Brexit, went on with Trump's first term, then COVID, war in Ukraine, energy, and now finding a peace solution. It's a little bit cacophonic, but it is united.
Do you worry that Russia is trying to influence different spheres, and with what's happening in the US administration, it makes it more difficult for Europe to go forward?
We need the United States, and that's why I think that the minerals deal is so important, because that could be the tipping point, which then gives a very strong business stake for the President of the United States, who works, for better or for worse, on a very transactional basis. So this is the reason I'm hopeful that we'll find a solution, and I think London is important from that perspective as well.
Why is it important to have Europe at the table when any peace agreement or any other agreement is negotiated between the US and Russia?
Because this is not only about the independence, sovereignty, and territorial integrity of Ukraine. This is also about European security. It's about the free world, and it is about the international rules-based order. That's why Europe should be involved.
Finland's President Alexander Stubb speaking there to Bloomberg's Francine Lacroix. Coming up, investors await Trump tariffs on Canada, China and Mexico. We think they're going to take effect tomorrow morning, London time, 5:01 a.m. We're going to bring you more on what you should expect. That conversation is next. This is Bloomberg.
Welcome back to the opening trade. We are 50 minutes into today's session, and you are seeing green on the screen for the DAX and the FTSE 100. The CAC not moving much at the moment, but there is outperformance, of course, for the defence names this morning. Double-digit growth for some of these names this morning. Leonardo, BAE, SAAB, Thales, Rheinmetall, interestingly, pairing some of its earlier gains, but still up 9% this morning. But let's turn to another story that is rippling through these markets, and it is, of course, tariffs. President Donald Trump just 1 day away from slapping new tariffs on Canada and Mexico and doubling a levy on China. The moves are set to upend ties with the biggest US trading partners, and we can speak now to Brendan Murray, who leads Bloomberg's global trade coverage. Brendan, when we look into these markets, Valerie Teitel was saying it earlier, the FX market in particular suggests that when it comes to Mexico and Canada, you're going to see another delay, not implementation. I wonder, when they're just kind of a negotiating tactic, at what point do they lose their power if the bark is never followed up with a bite?
No, exactly. That's the main question is, the 25% tariff on Canada and Mexico would have an immediate and very large detrimental effect on the U.S. economy. It would be immediately felt through the auto industry. So you can imagine auto industry CEOs in the U.S. are going to be on the phone to the president to tell him, if you do this, production shutdowns are coming, job losses are coming. So you could imagine that the pressure will be very high on the U.S. president to delay. Perhaps he's got his joint session of Congress speech tomorrow night. those tariffs, those North American tariffs, you would assume the investors and financial markets would not react well to those. Does he want to go into that speech tomorrow night with kind of a pessimistic view about where the U.S. economy is going?
And Brendan, when you're looking at Mexico, Canada, and people sort of lump those together perhaps sometimes, and then there's China as well. I mean, what are you looking at as more material? I'm thinking of this in terms of risk appetite and how this plays out for other markets. Which appears to be more consequential? Which tariffs?
In the short term, the Canada and Mexico tariffs definitely are more consequential. The China tariffs seem to be more gradually phased in. We've had 10% tariffs on Chinese imports for the past month. Importers, U.S. companies are adjusting, but you've had the CEO of Walmart come out recently and say, American consumers are feeling the stress of this kind of thing. And you double it to 20%, that's even going to be even more stress. Look at Apple, which makes a lot of iPhones in China. Those are now those could become 20% more expensive than they were a month ago. Will consumers ultimately feel the sting of that? I think is a real question that the Trump administration thinks if we phase these in and we bring China to the negotiating table at some point, then we can perhaps work out a deal. But in the meantime, the tariffs are the pressure that we're going to apply.
This time tomorrow, do you think tariffs will be on Mexico and Canada?
I wouldn't want to predict anything, but I would imagine that there will be some sort of 11th hour announcement of a delay.
Is it lower or a delay? I guess is the question. What does that look like?
I would guess that there would be a delay.
Right.
Another month, and more time to maybe cite some progress, but we're not there yet. Maybe some smaller tariffs on a few items, sort of a token, follow through on the bluff that was mentioned. So I would imagine that when we get up tomorrow and the president is getting ready for his speech, the stock market is not going to be crashing because North America is in a trade war.
Okay, there you go, Lizzie. Brendan, nice to see you. Thank you very much indeed. You're still going to have a pretty busy 24 hours, I suspect.
Right, yeah.
Brendan's a busy guy right now. Brendan Murray.
And in terms of what we've got coming up this week, of course, the China NPC meeting is going to be huge in terms of the response to that tariff threat. And really, China getting back on its feet, getting back a bit of swagger, but those tariffs are going to test that momentum. And at the moment, markets kind of looking as if it's going to underwhelm.
It's going to be an incredibly busy week, isn't it? From tariffs tomorrow, then we go to that address to Congress. It's sort of like a State of the Union feel to it, even if it's not called that at this stage of his presidency. So you've got all of that building towards, as we mentioned in the first part of the programme, jobs data on Friday, but Friday seems so far away. An ECB meeting, EU leaders meeting to talk about Ukraine on
Wednesday
Thursday.
Feels like a long way away. There's a lot to get through between now and then. The story this morning, though, is definitely what's happening with these defence stocks. Huge rallies being generated across the board in terms of the defence stories that we are watching. As you can see, some really big gains. Some of them being paired a little bit, but these are huge gains on the back of already big gains. These stocks, some of these stocks are massively already year to date. Yeah, absolutely. I was just going to go through some of those. Rheinmetall, even though it's paired its gains today, but Rheinmetall up 77% year to date. Leonardo up by 63%. Thales and SAAB, both of those up by more than 45% year to date. The numbers those are.
But when you look at the bond space, 2-year bond yields down a basis point, 10-year bond yields up 2 basis points. Is that because the bond market kind of saw this coming already? Maybe.
It feels like we've been talking about this for weeks and weeks, but something woke stocks up today.
Absolutely. We've still got a lot to go for the bond market. Manufacturing ISM later out of the United States, the ECB later on this week. Anyway, it's been a busy morning. Hope you've enjoyed it. The Pulse is next. This is Bloomberg.